The accrual basis of accounting, established by the conceptual framework for financial reporting, requires that income and expenses are recognized in the accounting period to which they relate, regardless of when cash is received or paid. Consequently, year-end adjustments are necessary to ensure that financial statements faithfully represent an entity's financial performance and financial position. The four principal adjustments are accrued expenses, accruals, prepaid expenses, prepayments, accrued income, and deferred income, each ensuring compliance with the matching principle and IFRS accounting standards. 1. Application of accrual accounting. The accrual principle requires revenues and expenses to be recognized when earned or incurred rather than when cash transactions occur. This principle ensures that revenue is recognized in the period in which it is earned. Expenses are recognized in the period in which they contribute to generating revenue. Financial statements present an accurate measure of profit and financial position. Without accrual adjustments, profits may be materially overstated or understated, reducing the usefulness and reliability of financial reporting. 2. Accrued expenses, accruals. An accrued expense represents an expense that has been incurred during the accounting period but has not yet been paid or recorded. Examples include outstanding wages, electricity charges, audit fees, interest payable. The adjustment ensures that expenses are matched to the correct accounting period. Journal entry. Dr. Expense. CR accrued expense. Liability. The expense increases profit or loss charges, while the outstanding amount appears as a current liability in the statement of financial position. 3. Prepaid expenses, prepayments. A prepaid expense arises when payment has been made before the related economic benefit has been consumed. Examples include insurance premiums, rent paid in advance, maintenance contract, software subscriptions. The unused portion represents a future economic benefit and should therefore be recognized as an asset. Journal entry. Dr. Prepayment, current asset. CR expense. The adjustment reduces current period expenses while recognizing the future benefit in the statement of financial position. 4. Accrued income. Accrued income represents income that has been earned but has not yet been received or recorded. Examples include interest receivable, rental income, earned consultancy fees, outstanding commission receivable. The adjustment ensures that income is recognized in the period in which it is earned. Journal entry. Dr. Accrued income, current asset. CR income. This increases reported revenue and creates a receivable in the statement of financial position. 5. Deferred income. Deferred income, unearned revenue, arises when cash has been received before goods or services have been provided. Examples include rent received in advance, annual subscription service contracts, advance customer payments. Since the performance obligation remains outstanding, the amount received represents a liability rather than current income. Journal entry. Dr. Income. CR deferred income, current liability. The adjustment postpones revenue recognition until the related services or goods are delivered. 6. Calculation of year-end adjustments. Year-end adjustments require determining the portion relating to the current accounting period. 4. Expenses. Expense for year equals cash paid plus closing accrual minus opening accrual minus closing prepayment plus opening prepayment. 4. Income. Income for year equals cash received plus closing accrued income minus opening accrued income minus closing deferred income plus opening deferred income. These adjustments ensure compliance with the accrual concept and accurate determination of profit. 7. Ledger entries and reversals. Year-end adjustments are recorded through manual journal entries and posted to the general ledger. Accrued expense. Dr. Expense. CR accrual. Prepayment. Dr. Prepayment. CR expense. Accrued income. Dr. Accrued income. CR income. Deferred income. Dr. Income. CR deferred income. At the beginning of the next accounting period, many organizations reverse these entries to simplify recording of subsequent cash transactions. For example, Dr. Accrual. CR expense. This reversal prevents duplicate expense recognition when payment is eventually made. 8. Impact on profit and net assets. These adjustments directly affect both profit and net assets. Accrued expenses. Increase expenses reduce profit, increase current liabilities reduce net assets. Prepaid expenses. Reduce expenses increase profit increase current assets increase net assets. Accrued income. Increase income increase profit increase current assets increase net assets. Deferred income. Reduce current income reduce profit increase current liabilities reduce net assets. Correct adjustments therefore ensure that both profitability and financial position are reported fairly. 9. Presentation in financial statements. Statement of profit or loss. Expenses include accrued expenses and exclude prepaid amounts. Income includes accrued income and excludes deferred income. This ensures that reported profit reflects economic activity during the accounting period. Statement of financial position. Current assets. Prepayments accrued income. Current liabilities. Accrued expenses deferred income. These balances represent future economic benefits or obligations existing at the reporting date. Accruals, prepayments, accrued income, and deferred income are essential year-end adjusting entries that implement the accrual basis of accounting and the matching principle. By recognizing income when earned and expenses when incurred, irrespective of cash flows, these adjustments ensure that financial statements provide a faithful representation of financial performance and financial position. Proper journal entries, ledger updates, reversals, and financial statement presentation strengthen IFRS compliance and improve the reliability, comparability, and decision usefulness of financial information for investors, creditors, and other stakeholders.